AppLovin Corp on the Nasdaq under ticker symbol APP is currently trading at 600.91 USD, which marks a sharp decline of 67.72 points or approximately 10.13% during today's session on January 14, 2026. This sudden downward pressure comes at a time when the broader tech sector is showing mixed signals, but for a company that was essentially the darling of the high-growth software world throughout the previous 12 months, this nearly double-digit intraday slide is catching many off guard. While the market sees a massive red candle on the daily chart, the hidden reality is that this move is less about a breakdown in fundamentals and more about the brutal mechanics of institutional profit-taking and high expectations meeting a very crowded trade. Even as Evercore ISI just initiated coverage with a bullish price target of $835, the stock is seeing its heaviest selling volume in weeks. It's the classic scenario where the news is good, but the price action suggests that everyone who wanted to buy has already bought, leaving the door open for a sharp correction as the big players trim their positions. The expectation surrounding AppLovin heading into 2026 was that it would continue its trajectory as an unstoppable AI winner, often mentioned in the same breath as Nvidia stock or Palantir stock. Investors have been conditioned to expect massive beats and raises every single quarter. However, the reality of today's movement shows that even the most robust growth stories eventually hit a valuation ceiling where the risk to the downside becomes too great for major funds to ignore. This isn't just about a single company, it is a reflection of a broader trend we are seeing across high-momentum names like Apple stock or Tesla stock, where the margin for error has become razor thin. When you are trading at a price-to-earnings ratio north of 70, you aren't just being priced for perfection, you are being priced for a future that hasn't even been written yet. The current slide to just above the $600 level represents a significant test of support that could determine the trend for the rest of the first quarter. If you look at the trading data from platforms like Interactive Brokers or the activity we see on the Robinhood app, it is clear that retail sentiment remains relatively optimistic, but the institutional side is where the real pressure is coming from. Large blocks of shares are being moved, likely as a result of year-end rebalancing that spilled over into the first few weeks of January. This kind of volatility is why many people are turning toward more automated solutions like Schwab Intelligent Portfolios or exploring specialized mutual funds and Fidelity ETFs to manage their exposure. The days of simply buying a high flyer and watching it go up 10% a week might be taking a breather. Online investing has become increasingly sophisticated, and today's action in APP is a masterclass in why understanding market structure is just as important as understanding the underlying business. Comment below how many shares of AppLovin Corp you currently hold, or if you are waiting for a deeper pullback to the 550 range before entering. To understand why this move is happening today, we have to look at the recent momentum. In 2025, the stock was up over 100%, outperforming almost every other major software name. This kind of run creates a situation where the stock becomes extended, far above its moving averages. When a stock gets that stretched, even a positive catalyst can lead to selling as traders use the liquidity to exit. It's the expectation versus reality gap in its purest form. The expectation was that the new price targets from Wall Street would push the stock towards $750, but the reality is that the market needed to flush out the late arrivals. We are seeing similar patterns in other high-growth areas where self-investing has become popular as individuals try to navigate these swings without the cushion of a diversified portfolio like those offered through Fidelity Wealth Management or a dedicated SoFi active investing account. Let's look at what this company actually does because it has fundamentally changed over the last 2 years. AppLovin transitioned from a mobile gaming powerhouse into a pure-play advertising technology firm. They effectively sold off their gaming studio business to focus entirely on their Axon 2 engine, which uses advanced machine learning to help advertisers find the right users at the right price. This shift is what drove the massive margin expansion we saw in recent reports. When you look at the financial health through a Fidelity trading platform or research the data on SoFi stocks, the numbers are objectively impressive. We are talking about net profit margins nearing 60% and revenue growth that is still holding in the high double digits. This isn't a company struggling to find its footing, it's a company that has found a very lucrative niche and is now defending it against the likes of Google and Meta. However, the risk profile for online investment in a name like this is always tied to the broader advertising market. If we see any cooling in consumer spending, or if the shift toward e-commerce advertising hits a snag, these high multiples will continue to compress. This is why many investors are looking for investment help or using tools like a SoFi robo-advisor to balance out their high-tech holdings with more stable assets. Even for those who prefer an individual brokerage setup, the temptation to chase the next Nvidia stock often leads to ignoring the risks of a localized bubble. Today's 10% drop is a reminder that in the world of invest online, what goes up fast can come down even faster when the institutional tide turns. Institutional activity shows that while firms like Vanguard and BlackRock have been increasing their stakes throughout the fall, we are seeing a significant amount of insider selling. The CEO and other directors have been trimming their holdings significantly over the past few months. While this is often planned well in advance, the optics of insiders exiting while the stock is near all-time highs can weigh on the minds of retail investors using a Robinhood trading account or looking for the next big move on SoFi investing. It creates a tension where the public narrative says buy the dip, but the actual movement of the people closest to the business says take some off the table. The business model itself is built on a feedback loop. The more data their AI engine processes, the better it gets at targeting, which draws in more advertisers, which generates more data. This is why their expansion into e-commerce is such a major catalyst for 2026. They are trying to take the same technology that conquered mobile gaming and apply it to a much larger market. If they succeed, the current $200 billion market cap might actually look cheap in retrospect. But the reality is that breaking into e-commerce puts them in direct competition with giants who have much deeper pockets. It's a bold bet, and the market is currently debating whether they can pull it off without sacrificing those industry-leading margins. This is the kind of deep analysis that moves beyond the surface-level charts you might see on basic investing sites. Looking ahead, the next major catalyst will be the earnings report in February. Analysts are looking for continued growth in their software platform revenue, which is the high-margin part of the business. If they can show that the self-service tools they've been developing are gaining traction with smaller advertisers, it could provide the fuel needed for a recovery back toward the $700 mark. Until then, we are likely to see continued volatility as the stock finds its new floor. For those using Fidelity IRAs or managing long-term wealth through Fidelity investments, this might just be a blip on a multi-year chart. But for the active traders on the Interactive Brokers platform, these intraday swings are where the real opportunity or the real danger lies. When you compare AppLovin to other tech leaders, the story remains one of extreme efficiency. Unlike many companies that have had to lean into heavy capital expenditure to keep up with the AI trend, AppLovin has managed to grow while remaining incredibly lean. This is why they are often a top pick for those seeking high alpha in their SoFi ETFs or looking for specific growth names within a Robinhood crypto and stock portfolio. The company doesn't need to build massive data centers, it just needs to keep refining the algorithms that run on existing infrastructure. This capital-light model is a dream for investors, but it also means there are fewer barriers to entry if a competitor develops a better algorithm. That is the ultimate reality check for this stock. Their moat is built on code, not on physical assets. As we wrap up this analysis, it's important to return to the core theme of expectation versus reality. The expectation was that AppLovin would be a straight line to $1,000. The reality is that the path to those levels is paved with 10% drawdowns and periods of heavy consolidation. Today's price action at 600.91 USD is a stark reminder that even the best companies are subject to the laws of gravity when they get too ahead of themselves. We've seen this play out with Apple stock and Nvidia stock time and time again. The investors who succeed in this environment are the ones who don't get caught up in the hype, but instead look at the underlying cash flow and the sustainability of the growth. Whether you are using a Fidelity mobile app to check your balances or placing active trades on a Robinhood cash management account, the key is to stay disciplined. AppLovin is a high-performance machine, but every machine needs a tune-up. This correction might be exactly what the stock needs to set up its next leg higher later in the year. The transition to a pure ad tech model and the expansion into e-commerce are the pillars that will support the company's future, but the market is currently in a show-me phase. They want to see those e-commerce numbers translate into actual bottom line